I'm not sure if some of you remember, but during COVID, rents actually dropped by a whopping 20%. Now that we are in a technical recession by definition based on our latest GDP data, what do you think this would mean for rents moving forward? Well, in this video, let's dive into this a little bit more and find out. Stay tuned. As real estate investors, timing the market is hard, and that's why we often say that instead of focusing on the price risk, the more important thing is to make sure that the rental numbers make sense. Well, now that interest rates are looking like they're leveling off, you probably want to know how far off rent projections might be if rents change in the future. And one factor that might affect where rents would go would be where our economy is headed. Now, to see where we are, the Bank of Canada is closely watching our GDP data, especially in the third quarter. And what we just saw is 2 quarters of economic slowdown in Q2 and Q3. And that means Canada is now in a technical recession by definition. So what happens next is twofold. We're likely going to be at peak interest rates given where we are with the economy, and this is definitely going to support home prices. But a recession also means typically fewer jobs and possibly lower rents if renters' incomes get impacted. Rents often track interest rates as landlords pass the increased cost to tenants, and we clearly saw this in the past year and a half. When interest rates shot up very quickly last year, we also saw rents shoot up very quickly as well. But now, if the big banks expect interest rates to come down slightly in 2024, how much might rents come down in this case? Math can tell us part of the picture. So if interest rates do come down by around 1% by end of 2024, this could mean that rents can come down by 8% if we want cash flows to stay more or less the same. But like I said, that's just part of the picture because our rental fundamentals are actually strongly supporting rents nowadays, which is very different from what happened during the pandemic when rents came down by a huge 20% pretty quickly. Now, here's the difference. During the pandemic, we closed off our immigration borders and we saw an urban exodus where many renters in Toronto left to the suburbs temporarily. Nowadays, immigration is definitely on the rise with huge targets, and people are generally coming back to the cities, so the rental demand is much stronger than before. On the supply side, we are seeing less interest in real estate investing simply because of high interest rates and the uncertainty. And what this does is create less new rental housing compared to what happened during the pandemic, and this is crushing new rental supply, and both of these factors are giving support to the rental market and rents, even if we are in a recession. Now, employment is still a very real risk for rentals if we do hit a recession. And we do believe that renters are still going to stay in the city. And with our diverse economy in Toronto, there could be a lower risk compared to single sector economies in many of the smaller towns. But what we could see is a shift to more affordable rentals, which might end up meaning bigger rent drops in condos and more demand and rent support for multifamily apartments. At the end of the day, we do think that the real estate market in Toronto is definitely becoming more predictable. Changes in real estate prices are expected to swing less compared to the past year and a half. Interest rates are leveling off too, and there's just a strong upward support for rents too, even if we are in a recession. So there's just more certainty for us to make clear math-based real estate investing decisions when we look at rental income and cash flows. Just for inspiration, here is a deal we've been eyeing lately. This is a house in prime Toronto that might end up selling for $800,000. Yes, it is an amazing price given the location being 10 minutes to downtown, but let's check if the numbers work. The house does have strong bones, but it does need around $100,000 of renovations to finish up 3 one-bedroom units. And after everything is done, we could hit $6,500 in rents, and that translates to $1,500 of monthly positive cash flow if we assume we lock in 3-year fixed rates of 6%. The downside price risk is lower given the great price and strong cash flows and the lower volatility in price projections moving forward. The interest rate risk is also minimized with a 3-year fixed rate. And since each of the one beds are rented much lower than condos at $1,750 to $2,400 a pop, there's lower rent risk in these units too. And so this is something that we would say is a great opportunity today. Of course, this specific house might not be the right fit for you, but there's definitely other great options even if you're looking for smaller renovations or bigger value add. If you do want to explore different options based on your needs, just reach out to us. We're not your typical real estate sales brokerage. Our team's main focus are on cash flowing investment properties in Toronto, and we're here to help you find the right one and help you through renovations too, if that's something you're looking for. To get started with our team, just head over to this link right here to set up a Zoom call with us. If you found this video helpful, please give us a thumbs up and subscribe to stay updated with our content. Our channel covers a variety of real estate and investing topics in Toronto, and we provide services like planning, analysis, buying, selling, renovations, leasing, and property management to make your real estate investing journey easier. Just check out our website or connect with us on social media. Thanks so much for watching, and we'll see you in the next video. Bye.